I want to show you something remarkable. Buried in the rulebook of the COMEX, the world's largest metals exchange, sits a clause that most traders never read until it's too late. It's called force majeure, and if you think it's just legal boilerplate, just standard contract language that'll never get invoked, you're dangerously unprepared for what's building in the precious metals market right now. Force majeure. The term sounds academic, doesn't it? Almost quaint. It's French for superior force, circumstances beyond anyone's control, acts of God, natural disasters, war, the kind of events that let parties walk away from contracts without penalty. But here's what they don't advertise in their glossy COMEX brochures. Force majeure isn't just about hurricanes or earthquakes. It's an escape hatch, a ripcord for when the system breaks down. And in the context of the commodities market, particularly precious metals, it means something very specific and very dangerous. The exchange can simply decide not to deliver physical metal, even when they're contractually obligated to do so. Let me put that another way. You could hold a gold futures contract. You could follow every rule, do everything right, demand physical delivery, and the exchange can turn around and say, sorry, force majeure, here's cash settlement instead. They determine the price, you get paper, the metal stays wherever it is, or more likely, stays wherever it isn't. Now, before you think this is hypothetical fear-mongering, we need to look at the actual mechanics here, because the structure of this clause reveals everything about how fragile this system really is. Consider this for a moment. The COMEX operates on fractional reserve principles. Not officially, of course. They'd never use that term. But look at the numbers. At any given time, the amount of paper gold and silver being traded dwarfs the physical inventory sitting in their vaults by ratios that would make even a traditional banker uncomfortable. We're talking 100 to 1, sometimes 500 to 1 during peak trading. For every ounce of actual physical metal in their depositories, there are hundreds of ounces worth of contracts floating around. Multiple claims on the same bars. It's musical chairs with billion-dollar consequences, and everyone's pretending there will always be enough chairs when the music stops. The force majeure clause exists because the people who designed this system, the people running it, they know the math doesn't work if everyone shows up wanting their metal at the same time. They built in the self-destruct button from day one. Let's dig into the actual language. According to COMEX Rule 7, 01, and yes, I've read the whole thing, all the tedious legal prose, force majeure can be declared for acts of government, court orders, legal restrictions, wars, terrorism strikes, accidents, fires, floods, or any other cause beyond the reasonable control of the exchange. That list starts specific and then gets wonderfully vague at the end, doesn't it? Any other cause. That's a clause wide enough to drive a convoy of armored trucks through. And that vagueness isn't accidental. It's designed for maximum flexibility when the system needs an exit. But here's the clause that should make your stomach drop. During force majeure, the exchange can suspend deliveries and impose cash settlement at a price they determine, not the market price, not the spot price at the time of your contract. Whatever price the exchange committee decides is fair and reasonable. Now let that sink in. You bought a contract for gold at $2,400 an ounce. The spot price is now $3,200. Physical metal is impossible to find at any price, but the exchange declares force majeure and cash settles your contract at $2,600, a price they pulled from wherever serves their interests. You have no recourse. You have no metal. You have a check for substantially less than what your contract should be worth, and the fine print says you agreed to this. This isn't conspiracy theory. This is literally written in their rulebook. Now, here's where it gets interesting. Force majeure has been invoked before. Not often, but the precedents exist. In 1980, during the Hunt brothers' silver squeeze, the COMEX changed the rules mid-game to prevent a delivery crisis. They didn't technically declare force majeure that time, they just switched to liquidation-only trading, which prevented new buyers from entering while forcing existing longs to sell. Different mechanism, same result. The exchange protected itself and the short sellers by rewriting the rules when physical delivery pressure got too intense. More recently, during the COVID panic in March 2020, we saw something fascinating happen. The spread between COMEX futures and London spot gold blew out to over $100 per ounce. That's not supposed to happen. These markets are supposed to stay aligned through arbitrage. But when planes were grounded and refineries shut down, suddenly getting physical gold from London to New York vaults became difficult. The COMEX had to quickly approve new types of gold bars for delivery, 400-ounce London good delivery bars, instead of just the standard 100-ounce COMEX bars, because they were running out of eligible inventory. They didn't declare force majeure, but they came uncomfortably close. The system creaked, it bent. The fact that it didn't break was more luck than design. And that was just from logistics problems. That was just transportation difficulties during a pandemic. Imagine what happens during an actual shortage, a real supply crisis. Or during a monetary crisis, when everyone simultaneously realizes that paper claims on gold aren't the same as gold. This is the moment where we need to understand who force majeure actually protects. Because it's not you. It's not the farmer hedging his crop. It's not the manufacturer locking in silver prices for next quarter's production. It's not the individual investor who bought a contract expecting delivery rights. Force majeure protects the bullion banks. The institutions that are massively short these metals on paper while holding minimal physical inventory. When JP Morgan, HSBC, or Goldman Sachs have written more gold contracts than they can possibly deliver, force majeure is their insurance policy paid for by your assumption of contract integrity. These banks operate both sides of the market. They're COMEX clearing members. They trade their own books. They hold client positions. When a crisis hits, they're not just participants. They're the referees, the rulemakers, and the committee that determines whether force majeure gets declared and at what price settlement occurs. You think that's a conflict of interest? Welcome to commodities markets in 2025. Let's game this out. What would actually trigger a force majeure event at the COMEX? What conditions would need to exist for them to pull that trigger? Scenario 1, a genuine supply disruption. Major mining regions become inaccessible due to war, nationalization, or environmental catastrophe. We're not talking about one mine closing. We're talking about systemic disruption. South African mines nationalized, Russian metal sanctioned beyond current levels, a major refinery catastrophe. But here's the thing about this scenario. It would take weeks or months to develop. Markets would see it coming. Premiums would explode. The COMEX would have time to adjust, time to incentivize delivery from other sources. This scenario, while possible, probably doesn't trigger immediate force majeure. The exchange would try other tools first. Scenario 2, a delivery squeeze. This is more likely and more dangerous. A large entity, could be a sovereign wealth fund, could be a billionaire, could be a coordinated group, start standing for delivery on a massive scale. Not just one contract, hundreds, thousands, more physical demand than the vaults can actually supply. Remember, the COMEX only has a few million ounces of gold in deliverable form at any given time. That sounds like a lot until you realize that represents only a few thousand contracts. A single determined entity with sufficient capital could demand delivery on more metal than physically exists in the eligible category. When that happens, the shorts have three options: find metal elsewhere and ship it in, buy back their contracts at whatever price the longs demand, or convince the exchange to declare force majeure. Guess which option the exchange is most likely to choose when its member banks are staring at potentially unlimited losses. Scenario 3, currency crisis. The dollar faces a genuine confidence problem, not the slow erosion we've seen for decades, but an acute crisis. Foreign central banks start dumping treasuries. Inflation spirals beyond the Fed's control. In this environment, everyone runs to hard assets simultaneously. The COMEX gets overwhelmed not by one big player, but by thousands of smaller entities, all demanding physical at once. This is the nightmare scenario because force majeure becomes the least bad option from the exchange's perspective. Delivering the metal would drain vaults to zero and expose the fractional reserve nature of the system. Letting the squeeze play out would bankrupt member banks, so they invoke the clause, cash settle everything, and deal with the lawsuits later. Consider this for a moment. What happens the day after force majeure is declared? The immediate effect is chaos. Contracts get settled in cash at exchange-determined prices, but that doesn't make the physical shortage disappear. In fact, it makes it worse. Everyone who got paid in cash instead of metal immediately tries to buy physical elsewhere, from dealers, from mints, from refineries, from private holders. Premiums on physical metal would go parabolic. The two-tier market that already exists, paper prices versus physical prices, would become an unbridgeable chasm. But we can look at indicators, warning signs that delivery pressure is building. First, watch the COMEX warehouse stocks, particularly the eligible versus registered categories. Eligible means the metal is in the vault but not allocated to contracts. Registered means it's been designated to fulfill delivery obligations. When eligible stocks are high but registered stocks are dropping, that's a warning sign. It means metal is sitting in the vaults but owners aren't making it available for delivery. Second, watch the spread between futures prices and spot prices. Under normal conditions, futures trade at a slight premium to spot. That's called contango, and it reflects storage costs and interest rates. When that spread compresses or inverts, when futures trade below spot, a condition called backwardation, it signals immediate demand for physical metal. Sustained backwardation is a red flag that delivery stress is building. Third, watch the rollover behavior at contract expiration. Most futures contracts don't result in delivery. Traders roll them forward to the next month. But watch what percentage stands for delivery versus what percentage rolls. When that delivery percentage starts climbing, especially on large contract positions, it means someone is applying pressure to the physical market. Fourth, watch the premiums on physical metal at dealers versus the COMEX spot price. Right now, you can buy a 1-ounce gold coin for maybe $50 to $100 over spot. That's normal. It reflects manufacturing costs and dealer margins. But when premiums start hitting $200, $300, $500 over spot, when delivery delays stretch from days to weeks to months, that's the market screaming that paper price and physical availability have diverged. And fifth, watch what the bullion banks do with their own positions. This is harder to track in real time, but the CFTC releases Commitment of Traders reports every week showing the aggregate positions of different market participants. When the commercial traders, that's code for bullion banks, start dramatically reducing their short positions, when they're covering rather than adding to shorts even as prices rise, that could signal they're worried about delivery pressure. None of these indicators alone means force majeure is imminent, but in combination, if you see multiple red flags simultaneously, that's when you need to understand you're holding a very different kind of risk than you thought. Let's address the counter-argument because it's important. The optimistic view says force majeure will never happen because the COMEX has too much incentive to maintain market integrity. If they cash settle contracts involuntarily, confidence in the exchange evaporates. Trading volume collapses. The COMEX loses relevance. And there's truth to that. The exchange doesn't want to declare force majeure. It's a nuclear option that damages their credibility and business model. But, and this is crucial, when the alternative is the complete collapse of multiple member banks, when the choice is between damaged credibility and actual bankruptcy of the institutions that are the market, they'll choose force majeure every time. They'll deal with the reputation damage, they'll weather the lawsuits. What they can't survive is the liquidation of their clearing members. This is the same logic that led to the 2008 bailouts, the same logic behind too big to fail. When the system itself is at risk, rules get bent, contracts get modified, and those holding paper claims find out that their rights are subordinate to systemic stability. Now, here's where it gets interesting. There's actually a legal argument that force majeure in this context might not even hold up in court. If the superior force is actually just the exchange's own fractional reserve practices creating a delivery crisis they engineered themselves, is that really beyond their reasonable control? Some legal scholars argue that self-inflicted crises don't qualify for force majeure protection. If the COMEX allows more contracts to be written than they have metal to deliver, and that practice directly causes a delivery failure, they arguably created the condition that makes delivery impossible. That's not an act of God. That's negligence or deliberate business practice. But here's the ugly reality. By the time that legal question gets resolved in court, years later after appeals and expert witnesses and legal maneuvering, the crisis will be long over. You'll have already been cash settled. The market will have already restructured. Your legal victory, if it comes, will be Pyrrhic at best. The system counts on you not having the resources or patience to fight them in court for half a decade. They count on settlements and arbitration clauses, and your need to move on with your life. Justice delayed is justice denied, and in a force majeure scenario, delay is the entire strategy. So what's the play here? How do you position yourself if you believe force majeure is a real risk? Option 1, don't play the paper game at all. If your goal is precious metals exposure, buy physical and hold it yourself, not in an allocated account at a bank, not in an ETF, not in a pool account. Physical metal in your possession or in truly segregated allocated storage that you've personally verified. The premium you pay versus paper prices is insurance against exactly this kind of systemic risk. When you hold physical, force majeure at the COMEX is someone else's problem. In fact, it's your windfall. Your metal just became substantially scarcer while paper claims got cash settled at artificially low prices. Option 2. If you're trading futures for legitimate hedging or speculation, never hold through delivery month if you can't actually take delivery. Trade the front months, roll early. Don't be the one caught holding when the music stops. The delivery squeeze happens to those who wait until the last moment. Option 3. Diversify your counterparty risk. If you must hold paper claims, spread them across multiple jurisdictions and institutions. Singapore vaults, Swiss vaults, Canadian storage, Australian allocated accounts. Don't put all your exposure with COMEX-linked entities. When one system breaks, having claims in another jurisdiction might make the difference. Option 4. Understand your contract terms completely. Read the fine print. Know exactly what force majeure clauses exist in whatever you're holding. If you own shares of a gold ETF, do you know what happens if they can't source metal? Do they cash you out? At what price? Determined how? Most people don't read these documents. They assume gold ETF means gold exposure. Then they discover that what they actually own is a security that tracks gold to the extent practicable, with all kinds of escape clauses when tracking becomes impracticable. Let me hit you with a thought experiment. Imagine it's 18 months from now. The COMEX has just declared force majeure due to extraordinary market conditions and unprecedented delivery demands beyond the reasonable control of the exchange. Gold futures are cash settled at $2,800 per ounce. Physical gold, if you can find it, is trading at $4,200 in actual transactions. What's your situation? Are you holding cash-settled contracts wondering what happened to your gains? Are you holding physical metal that's suddenly worth 50% more than the official price? Are you scrambling to buy physical at massive premiums with the cash settlement you received? Your answer to that question should inform your strategy today. This is the moment where we need to zoom out and see the bigger picture. Force majeure at the COMEX wouldn't happen in isolation. It would be a symptom of broader monetary stress, currency instability, loss of confidence in paper assets, a flight to tangible value. In that context, the metals market breaking down is just one domino. Bond markets, stock markets, foreign exchange markets, they're all connected. A crisis big enough to trigger force majeure at COMEX is probably big enough to trigger all kinds of other break glass and emergency protocols across the financial system. We might see trading halts, circuit breakers, bank holidays, capital controls, all the tools authorities use when markets stop functioning normally. And in that environment, your rights as a contract holder, your legal claims, your expectation of free markets and rule of law, all of that becomes subordinate to whatever measures governments and exchanges deem necessary for systemic stability. I'm not saying this to be dramatic. I'm saying this because it's happened before. 1933, when Roosevelt confiscated gold and revalued it 70% higher after the confiscation. 1971, when Nixon closed the gold window and broke America's promise to foreign central banks. 2008, when money market funds broke the buck and the Treasury had to guarantee them. 2020, when the Fed bought everything that wasn't nailed down and Congress sent checks to every American. When crisis hits, the rules change. Contracts get modified. What you thought was guaranteed turns out to have asterisks and footnotes. Force majeure is just the precious metals version of that reality. Here's what the banks won't tell you. They've run the